Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Chief Economist Don Rissmiller. Don, how are you doing today?
Very good. How are you, Ross?
I'm doing really well. Thanks for asking. Thrilled to have you here today. You joined us at a very interesting time. There's a lot of eyes on the Fed. There's a lot of mixed economic data out there, even going as far as to a debate about whether we're in a recession or not. So I wanted to start by zooming out. The market right now is pricing in Fed rate cuts for 2023. And I wanted to get your thought on whether the Fed can meaningfully pivot like that without a deeper than expected recession. What do you think?
Not really, unfortunately. And I think that's the key criteria. The world where we have rate cuts is probably not something that's bullish for risk assets. And the disconnect between what the market's pricing in terms of the Fed backing off and what it would take to get there is where I see the problem, which is if we have rate cuts, that means the economy is really falling apart. Now that hasn't happened yet because the labor market and industrial production are still growing. There are plenty of weak data points like what we're seeing on housing, and that will likely lead to further concern as we go into 2023. But a world where we are cutting rates after this aggressive hiking cycle is probably not a world that is equity market friendly.
I think that's a really important point for people to digest, that a Fed pivot doesn't necessarily have to be a bullish thing for stocks and other risk assets. Zooming in a bit, you mentioned the labor market. It's obviously very critical. The Fed watches wage growth, wage inflation very closely. So one, I wanted to get your take on the job market, the indicators that you watch there. And then two, there's this idea that the Fed can kind of land the ship here by reducing what is a historically high number of job openings without necessarily causing a rise in unemployment, that would be commensurate with past recessions. So do you think that's a possibility? Do you think they can accomplish that?
Yeah, both very important questions here. And I think this gets to the idea of what a pivot for the Fed really is. If pivot means that we don't have to keep going at 75 basis points a meeting in terms of rate hikes, I could get on board with that. A 75 basis point rate hike is a very aggressive move. So if pivot means we slow down to a 50 basis point rate hike or maybe even a 25 basis point rate hike, there's support for that as we go through September, October, November, December, and into 2023. But if pivot means rate cuts, that's where I would draw the line and say the labor market would probably have to be printing negative payroll numbers. You'd probably have to be seeing rising unemployment and likely significantly rising unemployment to get that type of outcome. So the Fed's plan, and someone like Fed Governor Waller has laid this out, is that they think they can destroy job openings before they destroy too many jobs. And so we're relying on the pretty unique situation where we have a very elevated job openings rate in the JOLTS data, the Job Opening and Labor Turnover Survey. So it's very hard to find a historical comp for this simply because it hasn't happened this way in the past. So if there's hope that we can destroy job openings before we destroy jobs, we're basically saying it's different this time. We will have a situation where there is so much cushion for Fed tightening that absorbs most of what happens on the Fed funds rate and the quantitative tightening side.
That makes perfect sense. And, for the Fed, it's not just domestic policy issues, but there's a lot going on abroad as well. So war in Europe, China COVID-0, all of the other lingering effects from the pandemic over the last couple of years. So how do you think about how global supply issues affect what the Fed is trying to do with domestic policy? And maybe a better question is, how does the Fed think about that sort of thing when they're setting policy?
Yeah, it's a unique environment. And if we think about goods prices, those are typically set with a lot of global influence. When we think about global trade, where manufacturing is done, where the pricing power sits, that's a global story. So the Fed does care about international developments. They certainly care about shocks. But the typical central bank philosophy is if you have a supply shock, you want to look through it if you can, unless it starts to get to sticky prices. And sticky prices like rents or wages are basically domestic things, and they're tied to the domestic labor market. So I think what's changed over the past year, if you think back to last year's Jackson Hole versus this year's Jackson Hole, is we've seen the shocks which certainly started out as global events, supply events, and in the context of a demand stimulus, morphed into pressure in the domestic labor market and on wages. And wages are downward sticky. That's what is driving this aggressive Fed response. So the Fed cares about international developments, but right now the big problem is the domestic labor market is still overheating. And until that changes, I think that's going to attract most of their attention, even in the context of some of these very troublesome events abroad.
Well, perfect. That gives us something to watch going forward. Don, it's been tremendously insightful. I want to thank you so much for your time and look forward to talking again soon.
Thanks, Ross.